Another stock which I have rejected is Servotech Systems. This stock came in my screen list yesterday, and I decided not to put an order or not to put an alert for the stock. Let us discuss why I have rejected this stock. So first, let's look at the moving averages. So the 50-day moving average, which is the blue line, is above the 150-day moving average, which is the green line, which is above the 200-day moving average, which is the red line. So this is a nice stage 2 uptrending stock. That is a good sign. Next. This is today's candle, so I will not consider this. This is what I saw yesterday. This is the base that I saw yesterday. So if I look at the number of points in the base, this is 0.1, that's 0.2, 0.3, 0.4. So there are 4 points in the base, which means 2 contractions in the base, which is exactly what I want. I want minimum 4 points in the base. The more, the better. I also want more than 10 candles or at least 10 candles in the base, because 10 candles means 2 weeks of consolidation. 5 candles means 1 week, Monday to Friday. So if you look at these candles, see, this is 1, 2, 3, 4, 5, 6, 7, 8, 9. So there are 9 candles. There are not 10 candles. This is a primary reason why I have rejected the stock. I want to wait for 1 more candle. Okay. This is the main reason I have rejected the stock. There are other reasons as well, which I will discuss in this video, but this is the primary criteria that I look for. There should be minimum 10 candles in the base. There should be minimum 4 points in the base. And I should have the blue, green, red combination on the moving averages. This is my fundamental criteria. The only time I violate this criteria is when I have a lot of realized gains and I can take a little bit of risk on some stocks. So for example, if I have a lot of realized gains, I might risk some money here, okay? But I'm not doing that. Now, that is not because I don't have realized gains. I do have realized gains. But for this particular stock, there are other factors which are not in my favor, which I will discuss shortly. If those factors were in my favor, I would have probably taken this trade, okay? Because I have realized gains, which I can risk on this stock. So I hope you understand my thinking process here. Sometimes a stock might not meet my criteria, but from a risk management point of view, it would still make sense to take the trade. Okay, that is what I want to convey to you. If I draw this base, see, it looks like this. And notice that when I start counting the candles, I don't consider this candle, okay, because that candle completes 0.1. After this candle, the base actually starts. So this is the first candle where the consolidation actually begins. That candle fails to break above the high of the previous candle. That is why that candle creates 0.1. This is 0.1. So I start counting from this candle. And from that candle, I need minimum 10 candles, which I did not get in this case. So this is the chart. The chart itself tells me not to get involved in the stock. But for some reason, like for example, if I have a realized gain and I want to risk some of that realized gain on this stock by keeping my order at the high of this candle, so 139.40. If I want to risk a little bit of my realized gain on this stock, okay, then the chart looks okay. From a risk management point of view, it is okay if I put the order or if I just put the alert instead of putting the buy stop limit order. From a risk management standpoint, that would be okay. But purely from a technical standpoint, this is a reject. Okay. Now let's look at other factors. If these other factors, which I am going to discuss with you now, if these other factors were in my favor, I would have probably put in my order here, or I would have probably put in the alert here. Now, when should you put a buy order and when should you put an alert? That is a discussion for another video, because that also involves some risk management. Say, for example, if you put an automatic buy order at the yellow line, what is your risk? The risk is that the price might go up, touch the yellow line, and come down. Now, if you put an alert instead of a automatic order, what's the risk? The risk is, by the time you get the alert and by the time you come to the chart and by the time you put the market order, the price would have shot up 2, 3, 4, 5% maybe. Because sometimes when the price passes through the yellow line, the movement is so fast, because the yellow line is the line of least resistance, where the supply has dried down to a level where there are no sellers in the market. It's the big players trying to buy the stock from other big players. That is why the price rise is very fast within a very short period of time. And if you are not available in front of your screen during that period, you might miss the stock. Okay, you might not buy at the proper buy point. You might end up buying a stock which is extended in price. And that affects your risk, that affects your stop loss placement and things like that. So uh, don't take an extreme view. Like, for example, you might say, I will only operate with automatic orders. That's an extreme view. Or some people might say, I will only operate with alerts. That's another extreme view. You have to be flexible. Okay, sometimes depending on the risk, you have to decide. If the price is too close to the yellow line, you might want to go with the automatic buy order. But if the price is still at a decent distance from the yellow line, you might keep the alert slightly below, maybe 1%, 1.5% below the yellow line, and see if the volume is coming in. If the volume is coming in, you can start buying a little bit of shares as the price begins to go towards your yellow line, but not all shares, mind you, there is a risk. That is how you would play trade execution. Now let us look at other factors on this stock. So we go to Market Smith. So this is what I have on the Market Smith. This is how it looks like. Now, immediately you see a positive thing is you have a lot of blue dots here. Blue dot basically means when the RS line makes a 52-week high, that's called as a blue dot. Okay. So whenever you get a blue dot inside the base, okay, that is a very, very good sign. That's a positive sign, because it means that the stock is doing better than the market. See, as you can see, the RS line is rising, which means the stock is doing better than the Nifty 50 on a relative basis. See, this is Nifty 50. It is going flat, but the stock is going up. That is why the relative strength line is going up. So compared to the market, this stock is doing well. Coming to these ratings, EPS rating 80. What does this mean? This means that the stock has done better than 80% of all the stocks in the Indian stock market based on its earnings stability and earnings growth. Now, another way to look at this is there are 20% of stocks in the Indian stock market which have done better than this company when it comes to earnings. And 20% of 5,000 is roughly 1,000. So there are 1,000 stocks in the stock market which have done better than this company when it comes to earnings stability and growth over the past few years. So, and that is evident from the earnings numbers. See, minus 45 quarterly earnings growth, not impressive. Even consolidated, minus 49%, not impressive at all. If the earnings growth is declining, that's another negative factor. Okay, so this is a negative factor. Patrick Walker wants this number to be plus 40%, or the average of these two numbers, which is the quarterly sales growth, the recent 2 quarters, the average of those two numbers should be 40%. But in this case, even on a standalone or on a consolidated basis, that is not true. So that's a red flag. So EPS rating 80, not good. Price strength 80, not good, because There are 1000 stocks in the stock market which are doing better than this company. Few days ago, this stock had a relative strength of 90, 91, 92 when it was here somewhere. Somewhere here, I remember buying the stock and selling it out quickly. But now the relative strength has declined to 80, the price strength, not a good sign. Accumulation distribution rating A plus, which is fantastic. Group rank is 27, not great. I want the group rank to be less than 20 for ideal conditions. And number of funds has tripled. It has gone from 3 to 9. However, there are stocks where the number of funds that hold the stock is in the hundreds or in the thousands. But this stock, I mean, hardly any funds holding the stock. Moreover, look at the market capitalization. It's a tiniest of the companies in the stock market. Okay, so this kind of money, a big institution, okay, a foreign institution or a domestic institution, in a single day they can put this entire amount of money in this stock. So it's a very small company. Okay, that's another thing. Management ownership looks fine. The PE ratio is extended. That's not a problem. PE ratio is not a big deal, because if the price is making all-time highs and the relative strength is high, I wouldn't mind a high PE ratio. But that PE ratio has to be supported with earnings growth, which is not happening in this case. One good thing is that the shares in float, the total outstanding shares is 22 crore. Shares in float is 8.86. So only one third of the stock is available in the market for trading. Okay. So that is a good sign. If only one third of the stock is available in the market for trading, other stock is held by big institutions and management, then if some big institution acquires a major chunk of that one third, then there is a potential for rapid price appreciation in this stock. So this is actually a good sign. But looking at overall factors, and plus the price has just come out of a recent base. If you can see, it is written here, 24% from pivot in 27 days. So from this green dotted line, the price has already gone up 24% in 27 days. So it's just coming out of the base. The relative strength is rising, but because of all of these factors, and is not consistent with earnings, okay, I'm not comfortable buying the stock. Moreover, when the stock forms a base, we want the volume to decline. We don't want the volume to rise. In this case, as you can see, the volume is rising. It's not declining. And that is not a good sign. We want volume contraction and price contraction. We do have price contraction, not enough to give us 10 candles, but we still have volume contraction, price contraction. But we need 10 candles and we need volume to, the volume in the base should look like this, significantly below the moving average line. The moving average is the 50-day simple moving average of the volume. So given this entire discussion, what do you think? Do you see confidence in my voice when I talk about this stock? No. Confidence comes only when all the factors are in my favor. I want both of these numbers to be in the 90s. I want the master score to be at least 80, 85. I want accumulation distribution rating to be A plus. Group rank should be less than 20. Management ownership should be high, at least more than 50%. Number of funds should be 100,000 funds maybe, and increasing. The EPS growth should be minimum 40%, or sales growth should be more than 40%, the latest 2 quarters. Plus, there should be tightening in the base on the right side. Plus, the relative strength line should be rising. Plus, there should be a blue dot. When all of these factors come together, it gives me the confidence to put 5% or 10% of my portfolio in a stock with a decent stop loss of 8% and give the stock some time to run. Okay, that is what I wanted to discuss in this video. And I haven't looked at the weekly chart. Let's see if the weekly opens. Yeah, if you look at the weekly chart, the stock has just come out of the base. Okay, it creates a base here, comes out, again creates a base here, comes out, again creates a base here. This is a base on top of this base, again comes out, again another base, again comes out. So we are not buying at the base. We are buying after the stock is up 25% from the base. So naturally, if we are making a purchase there, after it has already gone up 25% from the base, we are buying an extended stock. So we probably have to wait. We probably have to wait till we get a new base on top of the previous base. Just like what happened here. This is a base on top of this base. So if we get a decent base on top of this base, and if the relative strength increases, we might consider the stock, but not now. Thank you so much.